Okay, the first health insurance apparently was in 1694. The first U.S. health insurance company was Franklin Health Insurance Company of Massachusetts, 1850. There was an important step forward in health insurance with the Health Maintenance Organization Act of 1973, which required employers with 25 or more employees to offer what's called an HMO, a health maintenance organization. The idea at that time was that the medical services were generally provided by practitioners to uninsured people who had to pay when they were sick. The problem was that doctors made more money if people were sick. They didn't have any incentive to prevent disease. So there were people who complained that we needed to have our health managed by practitioners who had an incentive to keep you healthy, to do preventive things. So how do we do that? We have to create an organization like the Yale Health Plan that keeps you for a lifetime, let's say, that gives regular checkups to you and encourages you to come and talk to the doctor. The doctor has no incentive, because the doctor is paid a salary, has no incentive to urge unnecessary surgery on you or the like. So this is what Yale Health Plan, which was a pioneer, it was one of the first HMOs. What they do I think you've been there, right? They assign to you a primary, which is the gatekeeper for you, and they encourage you to come in for any minor thing, which might reveal a more serious problem. In 1986, the U.S. Congress passed another law called Emtala, Emergency Medical Treatment and Active Labor Act, which required hospitals and ambulance services to provide care to anyone needing emergency treatment. So basically it was a tax on everybody to provide emergency services. Now, you could probably go to an emergency room before 1986 because there was some public spirit that hospitals would treat you if you came in. But it became mandatory in 1986. But it's not the same thing as health insurance because they kind of hope that you take your sick people to another hospital's emergency room, not ours, because it all comes out of our pocket if you can't pay. So it's not a great system. Then we came, as you've heard of, the U.S. Patient Protection and Affordable Care Act of 2010, called Obamacare. It tries to deal with the selection bias problem by forcing everyone to sign up. So there's a penalty for individuals not buying insurance, a tax penalty. And a penalty for companies not offering insurance for their employees. So they set up health exchanges that tried to regularize the competition among insurance companies. It's a complicated system that the Republicans want to shut down as soon as possible. To me, Obamacare reflects some really important issues in insurance, namely that the U.S. has had something like 45 million people uninsured. And if they're uninsured, then they will go to the emergency room when they are dying, but they don't, it's not a good system because they don't get preventative care, and they only end up in the last stage of collapse at the medical system. So it's not perfect.
Earlier we were talking about mandatory flood insurance. Now that Obamacare is kind of pushing into that direction in the area of health insurance, do you think that's the right thing to do for the economy as a whole?
Well, see, health insurance has suffered an important shortcoming in the United States. Hasn't been offered by the government, it's private. And it's often through employers. So suppose you lose your job, then you've got to go out and buy health insurance. Now the problem is that they will look at you, and if you are sick, they'll say, we'll charge you a very high rate. And they also have a selection bias problem. We talked about this in class, that the people who sign up for insurance are the people who know they're sick and need it. So that means you have to charge very high rates. And then people who know they're healthy will not sign up because they don't want to pay the high rate. So nobody is insured, or not many people are insured. So in the Obamacare Act in Congress made it mandatory. Well, you'd pay a fine if you don't sign up for insurance. But that was supposed to put everyone back into a pool where everyone is insured, and was supposed to bring the rates down. So you have to do something like that. This is the fundamental problem with insurance. If it's not a risk, it doesn't work. If people know that they're at a special risk, then it's not going to work. You can only insure against the unknown. But you can make laws that prevent companies from taking account of risk factors so that people can buy insurance. And that's what Obamacare did.